Welcome everyone to the webinar. What a year it has been in the markets. Up 50% is the market so far. Was your pension up that much? Let's get into it and kick off and see what I like and what we should be doing for the year ahead. It's a good time because it's December. So you want to be looking at the year ahead. You're motivated to make good New Year's resolutions and the like. So all of that being said, how do things look? Let's get the lighting right. And let me share my screen with you, and I want to share the entire screen. Now, you should be able to see and hear me. Tell me where you're from, and that you can indeed see and hear me. That is critically important. So there we go. This is what we're going to cover. This webinar is really for everyone who is maybe everything from pensioners to 20-somethings who want to learn how to basically replicate themselves. You spend your life earning a living, and what you need to do is make an equivalent of yourself who, through passive income, can generate an income equal to what you're doing in your job and eventually surpass what you're doing in your job. So that's what this webinar and who this webinar is. I'll also tell you stocks I like, but I'll teach you how you should be picking them and why your IFA, your financial advisor, should be sacked if you have one, and why you shouldn't be trusting fund managers. So pensioners to 20-somethings, people who basically don't want to miss out on, well, the market was up 50% this year. Can I guarantee it'll be up that much next year? No, I can't guarantee that. But in a year where the market's up 50%, your pension should be at least up that much. It's also a webinar for those disappointed with their financial advisors, fed up with funds claiming to grow. And I'll show you some messages I've had from people who say, well, over 2 years, they've got a 0% return and their fund hasn't grown at all. So I'm going to explain how we get around that problem. Thank you, Ravi, my friend. Hope it's masala chai. It's actually coffee. Guernsey, Felixstowe, Surrey, welcome, Cardiff, London, Wet and Windy, Hampshire, Toronto, Canada, Anthony. Welcome from all the way from beautiful Canada. Okay, and people who are suspicious their IFA knows nothing and is actually working against them to basically sell them a load of funds. I've really turned against financial advisors because they really are, I'm just going to say it, they're incompetent. And fed up with UK companies not performing and giving them the kind of 50% return that the market's up. People missing out on basically growth and returns. And it's also for total beginners. So let me start straight away. And as I said, you should be able to see and hear me. I'm in the little corner over here, down here. And I've been looking at technology companies. Obviously, that's me speaking 2 weeks ago, just out in India. But we're going to focus on global stocks, US stocks suitable for your SIP and ISA. But if you're from Canada or wherever else, anywhere else, my pension manager should be sacked. 0% in 2 years. 0% in 2 years is what keeps coming up a lot. And I'm going to tell you some things to ask your pension manager, and I'll tell you the best excuses they always come up with. So thank you all tuning in from Bristol, beautiful Bristol. This is the stock market. It's pretty much near record highs. And that's how often since 2019 it's been at record highs. And guess what? It's spent a lot of time near highs in those last 4 years. So your pension should have significantly grown. But the classic excuse most fund managers have over 0% return for the last 2 years, and I can draw it in a graph, is this. In 2022, they did that. They didn't go into cash. They just saw the market fall and they fell with it. And then this year, when the market gave a 50% return, they only got back to where they were, okay, back there. So what's the basic problem? Basic problem is fund managers are not allowed to go into cash, which at least you can. The markets can only do one or two things, fall or rise. And when they're falling, we're not talking about timing here. We're talking about a 2-year gap. That's not exactly timing, is it? So how do we avoid that problem of when the markets are falling, being able to go into cash, but not trying to trade or time the markets? And when they're rising like this year, how do you make sure those gains add to your pension and not just recouping the losses your fund manager caused from the year before? Okay. And by the way, if you want to know where these profits are coming from, it just so happens they're coming from these sectors. Don't read too much into this. I don't really care for a top-down approach of, oh, healthcare, 90% of companies had revenues above estimates. Part of the reason why the market's risen is because the estimates have been lower than what the companies are delivering. The companies are delivering far greater revenues or sales, same thing. Earnings or profits means the same thing. Earnings and profits means the same thing. Revenues and sales means the same thing. So these companies have been doing a lot better. Not all of them. Materials and communications, those in financials haven't. Energy hasn't. Consumer staples, not really. It's been healthcare, utilities. Anyway, we don't take a top-down approach. We don't try and guess which sector is the right one. We look at the individual companies. And what I'm going to show you in this webinar is why I break it down across 10,000 companies by their valuation, their revenue growth, their dividend yields, and their cash flow. And most importantly, their Sortino and their alpha. And I'll come to that a little bit later on, because alpha is the ability to outperform the market, and Sortino is making sure you're getting an average return with as little volatility or risk of missing it as possible, which obviously is what we want to do. So we sort of reverse engineer what the outcomes are that we want through the share prices. Okay. Now, I'm going to continue going through all of these. Now, where are we? Well, first things, this is not individual financial advice, because I'm not talking to you individually. I don't know you individually, so I can't give you individual financial advice, okay? And that's what this says. Now, moving on to the very next exciting slide. I don't have a conflict of interest with you. I am not a retail fund manager. Okay, I'm not a stockbroker. I am not a Hargreaves Lansdown, AJ Bell, or Barclays trying to get you to open up a SIP with me. I have no SIPs to sell. I have no long-only funds to sell or retail client funds. If you want, you can buy a copy of my book. I'll be over the moon. I'll get £1 in royalties. Actually, one of any of my 18 books. But to be honest, you don't have to, because I'll give you a link to download it for free anyway. So even that, I don't have a conflict with you there. So in this webinar of great stocks to invest in now, that's the outline. We're going to go over the current market. We're going to identify high potential stocks and why they're so. We're also going to do a spotlight on where the big opportunities are for 2024. And then I'm going to talk about how you can ensure you can sack your IFA, your pension fund manager, and you should be getting better returns. Then we'll do a Q&A. Okay, we're going to do a Q&A. And I'm going to share with you a bunch of resources. And we're going to do, just to keep everything engaged, I'm going to, okay, a little funny one here. Will the Dow be, will end up 2023 by the end of the year from where it is now? Well, we've only got 3 weeks to go to the end of the year, or 2 weeks. So is it going to go even higher is what I'm asking you. So we'll do a little poll. This is where we stand year to date. This is what you send your fund manager, your pension fund manager, your workplace pension manager, and you say to them, right, NASDAQ up 50%, S&P up 20%. Why isn't your pension up somewhere between those two? After all you're asking them to do is to keep up with the market, and then watch them squirm as they say, oh no, oh, but that's those dreadful American companies. No, you're not American. You should do with poverty and poorer performance. You should be looking at those lovely emerging markets. And you do know Jeremy Swindon Swithe has got a very good education as a fund manager, and he will come around eventually in 5 years. Just give him time. These emerging markets will come around. They'll come up with all sorts of nonsense. Okay, but they can't even keep up with the market, the broader market, which is all we're asking them to do, for God's sake. So send them a copy of that, take a picture, put it on WhatsApp, send it to the fund manager and say, so tell me the excuses. And Alpesh has told me that you're going to come up with things like, well, we didn't invest in that. Let's be absolutely clear. This is not really much of an aberration. Did we think the market is going to go up this much this year? No, it's gone up more than we thought. But the fact of the matter is, those two tend to ridiculously outperform the UK. And sadly, people don't even realize in their SIPs and ISAs they can own US stocks. Okay, it's as simple as that. In fact, most people, if you show them this, will be in denial. They'll say, "Oh, but the markets have been choppy. I thought we're in a recession. I thought interest rates are high and there's high cost of living, and we should all be getting ready for poverty. That's what I've been told. Where is this from? No, this can't be real." They will actually be in denial even when we show them this. So, is 40% realistic? Well, the short answer is no. Certainly not for an IFA or fund managers. It's only realistic if there's a market tailwind, like in 2021 or 2023, and the market does incredibly well. So a tailwind helps. You can't do it in a year where it's a down year, like a financial crisis year. Of course it's not. It is only realistic if you've got what's called high Sortino stocks. In other words, stocks with a good average performance and very little volatility to the downside. Okay, so high reward, low risk. So they're consistent performers. Okay, and you can reverse engineer that. You don't have to try and understand AI in any particular sector. You just reverse engineer it by looking at the stock price and calculating the Sortino. Okay, and we'll look at that and which stocks I like at the moment in a second. In fact, the way I do it, just so you know, and I'll come to this a bit later on, just shove it all into a database, and then there's my Sortinos, and there's very few that meet it. This actually shows you how few actually meet that. And they've got to meet all, I need all greens right across the board. If it isn't all greens, you're not getting in. I'm very simple like that. Okay, it's not going to happen out of the UK. All right, so forget about it. It's just not. We don't grow that much, our companies. We don't, nobody's invented those kind of companies which can generate that without them being some kind of speculative tiny little AIM company which might occasionally have as much chance of blowing up as actually giving a result. It's not going to be emerging markets. You're just going to, it's like holding firecrackers in your hand. One or two might pay off. The vast majority will just blow up. Are you bloody kidding? Seriously. It's going to be really American companies to give you the right balance of reward and risk. Oh, by the way, alpha. What's alpha? Alpha is just outperformance of the market. And again, you reverse engineer it. You look for companies which deliver that. Simple. Okay. Now, of course, history is no guarantee to the future. Never has been. I don't have a time machine. And tomorrow morning, Putin might blow the whole world up. So there you go. I can't give you a guarantee that he won't do that. If you're looking for a guarantee he won't do that, well, I'm not the one. If you can go into cash in a bad year, 40% becomes realistic because it's not about the money you make. It's about the money you get to keep. You can't get a 40% average if, like in 2022, you went all the way down with the market. Now, fund managers can't go into cash. Let me say that again. Your pension fund manager is not allowed to hold more than about 5% cash. So in a bad year, ask your IFA, what happens in a bad year when nothing goes up like 2022, or pretty much nothing goes up like 2022? And the IFA will squirm. The pension fund manager will squirm because they'll say, well, we've just got to hold tight and hold on, because they're not allowed to go into cash. But they won't tell you that because they want to keep charging you fees. They can't charge you fees for holding your money because even a bank pays you bloody interest on your money. So they're basically lying and cheating you, but they don't call it that. So you have the advantage of being able to go into cash. By the way, you can't do 40% either if you're as rich as Warren Buffett. The reason Warren Buffett's an absolute bloody genius is because he can get a 18 to 20% return on billions, which means he's got a very narrow universe of companies to buy from which he can do it. There's other reasons. He got dividend deals from the 1950s and 60s, which are astronomical. But basically, you can't do it if you've got a lot of money because you'd end up having very few stocks you could invest in. You've got to be able, you can only do it if you're going to put all your eggs in one basket and watch the basket. In other words, if you're willing to monitor your pension just in case of any downdraft, anything which might drop, which you then prune away. You're not trading your investments. You're not timing the market. It's just in case once every 6 years the market falls. So you just got to keep an eye on it. So you might look at it once a fortnight. And I do it for you anyway on my Telegram. I do a weekly, I do twice weekly free market updates. Also, you can only do 40% if good years make up for bad. Okay? If your good years only give you 10% and the bad years give you 0, then you're not going to do it. So the good years like this year where the market gives you a tailwind of 50% on the NASDAQ or 20% on the S&P, they'll make up for the bad years. Okay? You can only do it if you've got croaky stocks. Now, how do we know this? Because I'll show you later. Goldman Sachs Wealth Management research shows that companies in the top quartile by croaky or cash return on capital invested generate on average 30% per annum. Not every stock in the top quartile by cash return on capital invested, and not every year. So in the financial crisis, none of them did. But the good years make up for the bad. That's critical. Okay, can't defy gravity. If everything's falling, you're not going to find stocks which are rising. It's just not going to happen, which is why Meta fell 80% last year, and it's important to be able to go into cash and get out of it. But this year rose 250%. You want to be able to capture the upside and not hold on to the downside as fund managers do. But you're not timing the market because that's bloody 12 months. That's not called timing unless it's all that, because you're in for whole 12 months this year and probably another 12 next year. Okay, so we need the high croaky stocks because statistically we know they put the odds in our favor. You'll only get to your 40% if you're going to hold for 12 months and then reevaluate, and you might hold for another 12. If you're trading, i.e. holding for a day or a week, you're not going to get that return. If you're holding for 5 years, you're not going to get it because the best companies which generate the most returns tend to have spurts of growth for about 12 months, and then they collapse. Like, now I'll give you an example of Meta again. Dropped 80% last year, okay, but rose 250 this year. Now, you don't want to hold it through those whole 2 years because you'll be zero. You've got a 0% return over 2 years, like most pensioners did. What you need to be able to do is hold for 12 months, reevaluate. And if it drops more than my usual rule of thumb, and I'll show you the flow chart in a second, more than 25% from the highest it's been since you bought it, you'd be selling anyway. So you've got to have that insurance policy that you will take action should it drop. But you're not, but that happens rarely. So you don't have to, like in 2022, which allowed us to keep our money. And you'll only be able to get 40% if the UK does 80%, 18% at least. That's my record since 2004. Not every year. Some years I did 36%, some years I did less. And the US does 2 times what the UK does, which it does, at least. Okay, so you've got to have a process which already works in the UK, looking at company data, and you're already able to extract 18% per annum out of the UK. Then you know that the US markets give you double that in any event, at least, because they just grow more. I mean, that's basically it. So is it possible? Yeah, but those are the rules. Those are the 10 rules that you'd have to adopt. Too complicated? Well, probably not, because it's worth it. It's worth it for your pension. Okay, it's not 40% every year. It's not guaranteed. There's bad years and there's good years. The good years make up for the bad years. So if we look at this year, where the S&P was up 20%, the NASDAQ up 50%, that's not me getting those returns. I didn't invent Microsoft and Apple and Costco and ServiceNow and Adobe. They got those results. I just read their coattails. And this is where we are with the S&P 500. It's broken out of that bloody downtrend that it was in, which we were worried about. And we thought, oh my God, this downtrend is worrying, and then all of a sudden broke out. Now, if you watch my weekly updates, you'd know what I'd said about during that period, and that we should see through it. There were 1 or 2 times I was a bit worried when it fell here. That's the point at which I think I sold Tesla because I wanted to ease back on equity holdings that I had. But given that we're looking from January to that, it was still good. And then, of course, a boom, right? So that's that. Now, FTSE 100 for those into the UK, well, bloody hell, come on, right? That's since 2018. So great. Let's just say all you did is follow the index performance. You're at 2018 level. So 5 wasted years. Congratulations. Well done. 5 wasted years. And that's what your IFA is going to say when you say, well, how come I didn't get a good return? You say, well, look, it's been 5 years. You've got to hold on for 5 years. And you've got what you kept all of that money. We went through COVID in that time. And you'll say to them, yeah, you little bugger. What about this, though? What about the fact that this has doubled in 5 years? Okay, because that's the S&P 500 down there 5 years ago. So the Americans have doubled in 5 years, just following the index, nothing else, not even the NASDAQ, the S&P 500. But the UK is at 0% in 5 years. Thank you very much. Okay, Steve, and some of these, I'll answer these questions as we go through. So feel free to put the questions in, but I will answer them a little bit later on if you don't mind. I'll do a little Q&A thing. So there you go. It's not me. I'm not any kind of genius. I'm just riding the coattails of people who are geniuses, like the people behind the companies. So the S&P has gone up 100% in 5 years. And if you just track the index, your pension doubled in 5 years, worst case, okay, which I think is pretty mediocre, given that I'm trying to cherry pick the S&P 500. But let's say I could do nothing better than keep at market levels. I didn't mess it up. Then my pension doubled in 5 years, and the FTSE gave me nothing in 5 years. Now, if I sound angry, it's because there's a whole bunch of Brits who in their SIPs and ISAs could have doubled their pension in the last 5 years by just doing market performance, nothing else. And they haven't. So God willing, there won't be a burden on the state because their pension's underperforming. All right? So I'm angry because they don't know this. And what happens? All their money's gone to fund managers. And I guarantee you, you ask your IFA, but can you just ask the fund manager how many kids he's got and how many of those kids are in private school? Right? Just wind them up and ask them, because it really makes me angry. So here we are with, say, an Apple. All right? I'll pick less obvious companies in a moment. And we are mindful that things can drop and don't always go up. Anyway, my current view on this. Now, let's call it the Apple strategy. I can either buy, hold, or sell. Now, I already hold a ton. If you watch my YouTube videos, my Telegram videos, everything's documented and timestamped. You know I hold a ton of this, okay? And I've been buying more throughout the year. Now, I'm certainly not selling. So if you put a gun to my head, I would buy more. right? Why? Well, not just because it meets all my criteria on value, growth, income, cash flow, and all of those factors. And that's very simple. I'll give you the flow chart in a second to make life easier. But also because, and I do like looking at charts, well, I'm pretty confident that the momentum is going to continue upwards, at least for now. And that's why I do broadcasts twice a week, because I put all my eggs in one basket and I watch the basket. By the way, all of Warren Buffett's investments are in 10 equities. That's it. And I can show you that a bit later on if you wish. They're in 10 equities. That's it. Him and a whole bunch of other billionaires. All their money is in just 10 equities. In fact, I might show you it now. Okay. So for those of you who think, oh no, it's Warren Buffett who said, put all your eggs in one basket and watch the basket. There you go. There's the billionaires. And they concentrate their wealth. Because again, in the words of Warren Buffett, diversification is an insurance policy against ignorance. So if you are ignorant about the markets, you should definitely diversify. You know, that's the insurance policy you take out. But if you know a little bit about what you're doing, then you would concentrate, put all your eggs in one basket and watch the bloody basket. Like I said, every Wednesday and Friday, that's why I do the market updates. I watch it for you. So as happened last year, and I didn't know it was going to happen last year. I didn't know it was going to be a down year last year. By February, we said, get out of so many stocks. By the way, I'll let you into a little secret. Okay. I'm going to let you into a little way in which I cheat, and I completely cheat doing this. I have said this before to people, but they might have missed it. So in February of last year, I saw that this was overbought. It's the monthly MACD. Okay. It's just one indicator, and if you don't believe in it, it's up to you. But I've written 18 books, which are over my shoulder. So who's on your side? Anyway. And that was most importantly fallen below its moving average. So if it's rising, that's pretty positive, especially if it's from a relatively low level, i.e. bottom end of the graph. If it's sideways, bit neutral. If it's falling, really bad. If it's falling beneath its moving average, really bad. And that's what happened. So we had to go into cash last year. Now that happens about once every 4, 5, 6 years. Okay, and that's why I keep watching it. I wear a seatbelt in my car because every 6 years I might have an accident, but I wear it every bloody day. Okay, so I monitor the markets twice a week. Is it worth it? Well, I think so, because I'm going to go take my pension with me to Bali. Right. Alphabet, same thing. Apple strategy. I told you what the Apple strategy is. Gun to head, I'd buy right now, but I'm continuing to hold. And that's why. Okay, that pattern's fine. If it did this, I would panic and worry, and that's why I'll keep an eye on it for you. And we avoid staying in during that. Do you know what your fund manager does? He owns it all the way down, so you can write a monthly newsletter saying to you, oh, it's okay. I know we're down 40%, but it was in Alphabet. Yeah, we rode the loss in a name you're familiar with, so that makes it better. Hey, it's your pension. Now, the NVIDIA strategy. Let me tell you this. So NVIDIA we got into in January. You can look on Telegram and all the rest of it. Not because I had any idea about AI in January. I really didn't. I didn't know NVIDIA was making chipsets for that. I thought they were making them for gaming machines and blockchain, which they were. So January, the numbers just flashed up as being bloody amazing. They flashed up as value, growth, income, cash flow. All of those numbers had come through. And the great thing about the Americans, unlike the Brits, is the Americans give you their accounts every quarter. The Brits only do it every 6 months, which is a real arse pain and another reason to have those American companies. By the way, your government wants you, British government wants you to own American companies, because actually then you're basically a net exporter. And they want you to export because you're bringing capital into the United Kingdom. Okay. And you're acting as landlord to their tenancy, and they're paying you rent. The Americans are paying you rent, and we want that. Good for balance of payments, if nothing else. Now, so the numbers flashed up on here on value, growth, income, cash flow, momentum, the whole shebang. So we got into it. I didn't know about AI. I don't gamble on the news ever, right? So what's now the NVIDIA strategy? When something's gone up, 200%, which is one reason why my pension's been rather healthy this year. I can't guarantee. I mean, look, next year I might get a 0% return. For the reasons I mentioned, the market might collapse. We might all be evaporated by AI or Putin. I don't know. But, so what's the NVIDIA strategy? It is, and I'll put this into the flow chart, which I'll share with you in a second. Because we can't see into the future, okay? We don't have time machines. All we can control is our risk appetite. If it drops X, we will sell Y%, okay? It's simple. Now, X is a number you can come up with, 10, 20, 15. Y is how much you'd sell. Now, for me, generally, that number is if it drops 25%, I will sell 100%. But I might decide for NVIDIA, if it drops, I've got a 200% return. If it drops 10%, I'll sell 50%. Got it? Based on my risk appetite. Your risk appetite is different to mine. Just as if we go to a restaurant, trust me, your appetite is going to be very different to mine. Okay? And given that this is somewhat overbought, as it was here, I don't want to have made these wonderful gains only to see them go, which is what happens to so many of you, and why you get a 0% return over 2 years through a fund manager, because they hold on all the way to the downside because they're thinking, what do I write in my monthly newsletter to my clients? Well, I'll write, didn't we do well in NVIDIA? Oh, it's falling, but don't worry, it's a great name, blah, 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 rubbish. Okay, because they're in the marketing business. They're not in the giving you a return business. They're in the marketing business to keep your money as long as possible, to get as many fees as possible. All right? And I'm telling you, that's what retail fund managers do. Now, we're keeping an eye on it. So that's called the NVIDIA strategy. Very simple. Now, ServiceNow turned out to be a lot better than I expected. Actually, I didn't expect this year to be 50% up. I didn't see COVID. I didn't see Ukraine war. I didn't see Middle East crisis. I could have bet on that, I guess, because roll the dice every other year. And I didn't see the financial crisis. So how the hell am I getting these stocks? Well, because I'm picking the kinds of companies which are resilient, which is what I suggest you do. They tick all the boxes of value, growth, income, cash flow, momentum, Sortino, alpha, low volatility, undervalued. Because we know valuation is important for future stock price moves, but we know it's not a guarantee of future stock price moves, and we know it's not the only factor. Same with growth, same with dividend deals. We know they're important, but they're not the only factor, and they can't guarantee anything. So we want to tick all those boxes and then filter till we get the most resilient companies. So if there's a tailwind, they do incredibly well. If there's a headwind, they shouldn't fall as far, or they shouldn't fall at all, or they should give us ample notice before they get out. And then we, as an insurance policy, monitor all of this at least once a fortnight. I do it twice a week just to make sure that pattern is not occurring. Okay, that's why. And that's the first one. And I'll answer all your questions as well in just a section. Theo, the answer is no. I get it from different sources. Okay, so what do I? So this is the first flow chart I want to show you. What do I do with my portfolio? Well, watch the free market update. This is my general rule. Okay, you only need to look at this part. You can take a picture of it on your phone if you wish. Has it been 12 months? Now, why 12 months, Alpesh? Why aren't you holding it forever? Because the world changes. Every single company in my portfolio gets sacked after 12 months. They've got to reapply for their job. So I might continue having Microsoft for the next 8 years, but every 12 months, it's got to be good enough to be re-included. Okay, just like a football team, they've got to reapply. They don't just get tenure. I don't care how crap you are. You get staying. It's my bloody pension. I'm answerable to my son and my wife. You better believe they're not nice people. Okay, they want the money. Is it a performance company? So basically, 12 months, right? And if it's fallen 25% from the peak, or NVIDIA strategy, have I become risk averse for some reason? We don't trade our investments, but as in February 2022, occasionally, once every 6 years, the market falls and tanks. And that's when we do say mid-year, well, it's not dropped 25%. I'm not going to wait for it to drop 25% from the peak since I bought it. I'll take that 200% return because it's dropped 10% from the peak and so on. Okay, very simple. I know I'm running through these things pretty quickly, but you should be quick on the uptake. Now, the other flow chart you need, and we always need a process. And the reason you need a process is peace of mind and to avoid buying loads of companies for no bloody good strategic reason. So what do we do with cash? Now, I will tell people every week on my Telegram, what's my risk appetite? Now, at the moment, I'm here. Now, imagine this is a scale, okay? From 0, because the markets are falling, like February 2022. Well, then we just wait. And then we ended up waiting in March. Then we ended up waiting in April. And that's because the markets, I can't see into the future. I don't have a time machine, but I can certainly see that I want to wait another month when they're falling, okay? And 10 is when I'm absolutely ecstatic, like in 2021. 10 is over here. And this is about a 7, okay? And that's where I am at the moment anyway. So I've got a whole bunch of stocks, what I call in my approved filtered list, volatility under 20%, mainly S&P 500 companies. And I'll go through some more which are in my portfolio at the moment, okay? Now, I want to show you a client portfolio before they joined Okay, actually, no, this one was a query I got from someone. Okay, this is an email query I got. And this is a typical portfolio. And I wanted to show this of why people underperform. So we took the stocks they had and the funds they had, and we put it into our own analysis. So we analyzed their portfolio just to sort of understand why are they sick and they're getting a 0% return. Their question was, Alpesh, my IFA's got me a 0% return. Okay. And we said, well, there's a couple of reasons for that. First of all, you've got a bunch of UK companies, which in and of itself is not necessarily bad. It's just that they don't tick any bloody boxes. Okay. Look, they're underperforming the market. They've got a lot more risk compared to performance. In fact, they're poorly performing. And you can see that in the momentum. They're barely generating any cash on the capital that they're providing. And there are a whole bunch of overvalued, undergrowing, lacking in dividend yielding companies. So they're basically a load of crap, which is presumably selected on name recognition. That's what they've done. All right, I'm not going to mince my words. I'm really pissed off that people spend their life earning a lot of money and then waste it by pissing away their pension. And then he's got these. Now, I don't have a problem with somebody having, let's say, treasuries and cash. We're basically getting returns on bonds. We'll put that to one side, okay? Put the bonds to one side. But there are basically way too many funds in here because each fund will own about 50 to 100 stocks. Take Scottish Mortgage. Now, the reason he'll have that is because it's got a name for itself, because when the markets rose, it rose with the market. So bloody genius. Well done. But when the markets tanked like last year and they couldn't go into cash, they dropped like a bloody stone. So as Warren Buffett says, when the tide goes out, you see who's swimming without shorts. And they were swimming without bloody shorts. In fact, they were fully naked. Right. Even worse, people who might got into it a bit late got in midstream. Do you think the fund manager said, oh, here comes John Smith, he signed up. Let's make sure we make something bespoke for him because we really care about him. No, they said, oh, crap, the markets are falling, but we can't go into cash, so we'll just drag John down with us and drown the poor bugger's pension, which is what they did, right, last year. And you might say, oh, it's not their fault. It's not their fault they can't go into cash. Them's the rules. Well, yeah, it's pretty bad, isn't it? You can go into cash if need be. Once every 6 years, you might need to. So too many funds is the other reason for very poor performance. And if you want to see the performance, what do you think the average of all that is? I don't know. It's probably 0% in the last 6 months. Like I said, this year, the market was up 50%. So this poor person didn't do so well. Let me show you somebody else, only because you can relate to it. This is somebody else who sent me in. They filled in my online portfolio review, and they said, last 2 years, 0 return. Okay, they've asked me, can I look at their portfolio? This is a list of the stocks and funds they held. So this is typical. They've got about 500,000 in there. They're 63, and have not revealed any of their personal details. So why have they got a 0% return? Well, North American International Equities Fund, 33% of their money's in there. But that's going to have about 100 stocks in it. So it might have a few of those companies which were part of that 50% market rise, but too little money in them. Why? Because that's got 100 stocks it spread it. And then on top of that, they've got UK equities. Obviously, fixed interest is fine because they might want to hold some cash. You don't have to put everything in equities. Then they've got Japan, which isn't doing too bad at the moment. But basically, that's your problem. Too little exposure and it's too diversified. Why do fund managers buy 100 stocks? Well, because they get paid on a percentage of assets under management. So their job is to advertise until they've got a lot of money to manage. And if they've got a lot of money to manage, they've got to spray and pray because they can't put it into just 10 companies. Otherwise, they'll end up taking over those companies because they might have 500 billion of assets under management. Okay, so they end up spraying and praying. And that has the added benefit that after 5 years, which they always tell you to hold on to, they'll have got you 0% return because that's what, as you saw with the FTSE, is generally what happens after 5 bloody years. And you'll say, oh, well, at least I didn't lose any. But they won't tell you how much you could have made. Here's another one. This is Ravi. It's not the Ravi we've got on the webinar, I'm pretty sure. I wonder if I'm too heavily exposed to one or two asset classes. Now, that's going to be a concern. And this person's got obviously quite a bit of the big name tech companies other than obviously London Stock Exchange. Ignore that. And Qualcomm, ignore Monks and that. So let's just look at, he's worried that, look, I've got Microsoft, Visa, Apple, MasterCard, Meta, Google, Nvidia, Amazon. And to this person, he's got 150,000 and he wants to double his investment as soon as possible. To him, I said, well, actually, it's fine as long as that's what the billionaires do. They have most of their assets in a small group. As long as you're actually monitoring it, you have an exit plan that if it drops X, you will sell Y. Now you need to be able to monitor at least fortnightly, and if it drops X, I'll sell Y. So you need an NVIDIA strategy. Otherwise, yes, you're too exposed. And if you were somebody who said to me, Alpesh, I want to pick the same stocks, but I'm going to hold them forever, I'd say, well, you're an idiot. You better get an index tracker. So unless you're willing to, as I said in the earlier slide, look at it every fortnight and just have the NVIDIA strategy in place, which is if it drops X, I'll sell Y, then you shouldn't. I mean, beyond that, they should be companies in any event which fit the profile that's on there. It shouldn't be just any random name of stocks. Here's another question. This person had $4.2 million. And he said, with those 40 points, generate a meaningful monthly income of $18,000. Well, that's easy. You could tap into the capital, but capital appreciation. So you don't just want to take your $18,000 a month out. You want to grow capital as well. And the problem, and this was his portfolio, so we put it into our language and we said, well, we can clearly see what the problem is. It's like we do an X-ray. You come into the hospital, you speak to Dr. Patel. There aren't many of those, are there? You speak to Dr. Patel and he does an X-ray. And there's a problem here. He's got a bunch of funds, which worries me a little bit. I don't mind the index trackers, but, you know, if he wants capital appreciation, then why has he got so much money in funds? Because funds you buy because you want less volatility. Okay, that's where you buy. Otherwise, you'd buy an individual stock. So you shouldn't have so many funds if he wants capital appreciation. And secondarily, the stocks that he's picked, too many of them aren't all green. They need to be green in these first 5 columns. There's only a couple of them which meet that criteria. There's a whole bunch which are basically not meeting that criteria. And as I said, in the last 6 months, there's a whole bunch which have given him next to zero return. Okay, negative return. And like I said, the market this year was up 50%. So he was worried that he's not getting the capital appreciation, because he's not ticking enough of the right bloody boxes. And secondarily, that he's got too many funds. So that was a simple overview of that. Now, Goldman Sachs had written this. I sometimes do this for fun. These 40 stocks are the biggest upside right now ahead of quarter 4 market rally. And there was a quarter 4 market, including one that could rise over 175%, they said. So I went through them. And let me tell you what the actual reality is. So when you see this, this is in a way what I'm saying about you can't trust journalists and you can't trust bankers. Because in actual fact, all of them are too early, and I did the analysis on it, with the exception of the ones I've marked in green, which I liked so much when this came out in November that I bought into the 3 that I've circled. Oh, no, 4 I already owned. Okay, I didn't do SBA, Communication, and Expedia. Everything else was too early. They were too speculative. So I disagreed with Goldman Sachs on that. So just be careful with journalist headlines and all of this, okay? On that as well. Now, how do fund managers? I've already discussed how they do it. The underperformance amongst fund managers is just ridiculous. And the reason retail fund managers get it wrong is because, like I've said, they collect so much money that they can do only certain geographies, certain styles, certain themes. Like they'll say AI stocks. Well, that's a pretty small universe, actually. Okay. And so they underperform time and time again. They're pretty rubbish. Let alone, oh my God, I hope you're not with St. James's Place. They really are. I mean, look, this is the Times, and that's 2020. £1 billion cost of sitting in a poor fund. And there's a whole investigation they've done, and they've done a few since, of just why you're being absolutely shafted. And they're making an absolute killing, okay, off the back of you. Or you could do fund managers like Blue Whale. Now, in 2022, when the market fell, these numpties were down 27%. It didn't occur to them to sell when they were down 10%, or when they were down 15, or 16, or when they were down 17, 18, 19, 20. Oh, anyway, it didn't occur to them. They just rode it all the way down because they can't hold cash. And when I posted this on Twitter and said that had no business being anybody's pension, an IFA actually messaged me back and says, well, yeah, no, you got to look at it over more than a year. I said, well, if you want to lose money, it's your problem. You want to make excuses as to why you're being slapped in the face by a pension fund manager whose kids are going to private school while yours can't afford to. That's entirely up to you. You deserve it, loser. Okay? And what about how to destroy your pension? Well, another way to destroy your pension is to go for name recognition. So, as I said, that Scottish Mortgage Investment Trust done well for many years while the tide was rising. And then when the tide fell, they dropped 50%. Great. Thanks very much. And that's in a lot of pensions. So let's get this right. If you got into that party in January 2022, your pension got halved. by a professional pension fund manager. In 1 year, halved your pension. Professional pension fund manager. Want to make excuses? Entirely up to you. People have a tendency when somebody stabs them, it's a very British trait, to say, oh, I'm really sorry for being, in your way of your knife. I don't know. It's just they need to get a bit more aggressive, perhaps. So what is my checklist? And I suggest you do. Well, we know we need to look at valuation. I don't care whether you look at price earnings or price earnings growth, but some metric of valuation we know is important. We want to tick that box, but we also need to tick the growth box. It's not either or. And that's a lie you've been told. There's got to be a value fund or a growth. No, it's got to be value and growth. Okay, we want both. Undervalued companies which are growing. Why can't we have both? And I've got 18 books over my bloody shoulder to say why. And by the way, the people whose research I've published in those books, and I did it in my Financial Times columns, I didn't invent any of this at all. I am just the messenger. Okay, the three people that I used to write about in my FT columns were Richard Thaler, Daniel Kahneman, and Eugene Fama. They all went on to win the Nobel Prize in economics. So I'm just copying, before they became Nobel Prize winners, the stuff that they'd been saying anyway. And are they rich? Well, Eugene Fama bloody well is, because he set up a fund as well. Momentum, trend, we know that's important, but we know it's not as important as valuation. And we know growth isn't important as valuation, but it's more important than dividend yields. How do we know this? Well, the academic research from the Nobel Prize winners that I've mentioned, right? And personally, I do it like this, get the answers and put it in. Now, here's what you need to know. You got to tick value, growth, income, cash flow, Sortino, alpha. If you don't, and you've got big gaping holes like this, big gaping holes in the middle, and then you say to me, what do you think of, for instance, SeaWorld Entertainment Inc., I will say, well, not what I bloody own, is it, mate? Buy. That's it. Okay? I can only tell you what's quality. I can't tell you what to do with rubbish. Monitoring frequently, once a fortnight. Okay, not every bloody minute. 12-month holding period, 15 stocks minimum, maximum about 40. And if it drops 25% from the peak, you'd sell. All right. One strategy, which is value, growth, income. I just showed you it's that strategy, right? I said 15 to 40. You can do 20 to 40 holdings. Why? Well, not just that, but also because I just showed you what the billionaires do. And what are the results? Well, 2021 wasn't exactly a classic year. But did I know Crocs was going to go up 208%? No. Ravi, you're on the webinar. You had that. And what happened if you didn't have that insurance policy of the NVIDIA policy of if it drops X%, you'll sell Y? You would have lost that whole 208% gain you made because you would have thought, oh, hold on forever. Or because it fell down again. So did Generac. So wait a minute, were they rubbish companies to begin with? No, they bloody went up 200% and 137%. Like a fruit, you pick it once it's fallen off the ground, it's ripened. You don't wait for it to go rotten. That's why we say 12 months, because these companies flourish for relatively short periods. And then, now there are a few, like a Microsoft, which flourishes year after year. They're perennials, but perennials are rare. The vast majority are, they'll do well for a 12-month period, then the market will get overexcited, over-exuberant, and destroy the hell out of them. Okay, or their management will start buying private jets and destroy the hell out of their own companies. Whatever it is, I don't care. Did I know it was going to go up that much? No, I didn't. If I did, I would have put everything into it, including money I didn't even have. Okay, because I would have leveraged the hell out of it and got 208%. Who doesn't want that? Right? Now, let's assume you plan to invest over 10 years. What does all this look like? And let's say you make 20% per annum. Some years more, some years less. Only because the market tailwinds are there and we're in the right market for all the reasons I've said. Okay, let's say you got 100K and you plan to add 1.5 a month into that. Well, you'll have $1 million in 10 years. Right? That's your job. That's my job, to turn every 10,000, to turn every 100,000 into $1 million for my family. That's my job. It's actually to do it in less than 10 years because they are very demanding like that with my expertise. But that's it, to turn 100 into $1 million, every 100 into $1 million every 10 years. Now, let's say you start with a more modest sum of just 10K and you add 6K a year divided equally by each month. Well, that's what it looks like. It's closer to my son's junior ISA. He can only have 9,000 a month tax-free in there. He is 5, about to turn 6. He's somewhere around here. This year was good. Last year was flat for him because we had to hold cash for most of the year. But the other previous year since he was born, you look at the markets gave well. Thank you. The market's a bit like the ocean. If they give lots of seashells and cockles, you do well. If they don't, you don't. Now, it could be that for the next umpteen years, he gets nothing because the market's just decided we're going to be rubbish. I don't know. I can't guarantee it, but I suspect not. I suspect we'll get somewhere closer to this. So when he's at university and I'm in Bali, he gets his 120 grand in passive income and doesn't bother me. Okay, love him though I do. I know he wants daddy for money. These are some of my past and present clients, paying clients, I should say. That I've written about all of this. None of this I've invented. All of this has come from two main sources. The economists who went to win the Nobel Prize, or Goldman Sachs. I'll show you some of the slides later from them. And I've just taken bits of what everybody said, and why can't we just tick each of these boxes? So instead of having a theory of only growth, only value, only income, why can't it be everything? And those are some of the books. Okay. And if you haven't, that's me with my team outside Downing Street. I don't know if that's a good or bad thing. You know, just politicians get it in the neck. If you haven't already, by the way, I've got a lot more to go. And I want to talk through some of the stocks. Do follow me on LinkedIn. Follow me on LinkedIn, because that's probably the best place to do due diligence on anybody. Okay. And you'll also see a lot of my posts and what my latest thinking is on anything as well. But there is a lot more. I had the great honor of I am name dropping here, or photo dropping there. Okay. And like I said, been writing for the FT since 1999 to 2004. Remember what I said about when to sell? You saw the flow chart. Now, this is a warning. Whatever you hold, please ask your pension manager to send you the PDF documents. Okay? You think you're paying 1%. You're not. This is from an actual client. Okay? And we looked at his things and what he was paying. £10,000 investment. If you cash in after 5 years, recommended holding period, because the con artist fund managers know that over 5 years, the markets will give you at least a 0% return. They know that because that's statistically what it does. That's your fees, 10%. 10%. Don't believe me? You don't have to. Go ask them for the PDF. Go look through it and tell them. Show them this, and then say to them, what's the equivalent for you? And I bet you it's going to come back like this, and you're going to get the shock of your life, because you're going to say, but I thought it was 1%. Yeah, proper scam artists they are. Now, I believe that, like driving, you can learn to invest, because all you're bloody doing is picking a load of green boxes. Value, growth, income, cash flow, cash return on capital invested, momentum, Sortino, alpha. That's it. Now, I explain what Sortino is. Average return, like a cricketer. The average is 50. But low volatility, that means every game gets 50 runs and out. Not gets 50 runs, but could be a century or a duck. That's high volatility. Okay, we want same performance with low volatility. So Sortino alpha outperforms the market. I'll put it in simple terms. You can learn the formulas if you want, but you don't need to. Here's the superhero, the patron saint of crap fund managers, Neil Woodford. Right? That's him in the Financial Times. Now, I exposed him as being crap in 2004. Because that's me winning that competition. Okay? In 2004, you know what they did? Because he had a beautiful square jaw, they gave him £9.2 billion to manage. It's the way the market works. Even if you're shit, we'll give you billions to manage because you've got a nice square jaw, bit of a busty chest. I had a fat jawline, so I didn't get 9.2 billion. I'm still seeing the psychiatrist for it. Now, once you've got those picks, once I've got my list, I might do a tiebreaker and look at what the billionaires own, but I don't pick it because the billionaires own it. It might be that, yes, out of this, I do own Apple. I do own Microsoft. Okay, not because they've got it, but it just hit all my figures. What doesn't hit my figures is American Express or Coca-Cola, because if I could have bought those in 1956 when Warren Buffett bought them, then it would have hit my figures back then. I'd still be holding it because the dividend yields from the number of shares he bought would be phenomenal. Okay, yes, I do own Amazon. And if today I could, I'd buy even more. and even more Microsoft, and even more Apple, and even more, I'll drop some more names, ServiceNow, and even more Costco. However, keep an eye on my weekly broadcasts because you never know what's going to happen in January. The market might crash and burn. I might, as a tiebreak, to see what hedge fund managers own. This is not recent, so don't go into AbbVie. I don't own it, but I might look at that. I'm not too bothered. I might look at discount cash flow to see if something's undervalued. I don't own this. Don't buy it. It's an illustration only. But I'm really, really looking at this. Okay, what you see on screen. And this is the Goldman Sachs slide I told you. So I was having lunch with Jim O'Neill when he was chairman of Goldman Sachs Wealth Management. And by the way, they'll do this for you if you've got 50 million pounds. They'll open a private wealth management account and do all this calculation for you. Okay. And charge you a fee on your 50 million for the privilege. So I stole the slide from the quantum database team. This is we're going back quite a few years now, about 2010, I think it was 2011 when I had the lunch. But I was blown away with their research. And what they found is 30% per annum is what companies in the top quartile by cash return, i.e. cash flow available on capital, generate on average. Not every year. Look, no company did it. There are some years where you will not get it, but the stronger years make up for the poorer years, 30% per annum. So I know I want to tick that box. It's not guaranteed. Not every company in there. If it did, it'd be a bank account with a 30% interest rate, and I'd be bloody laughing. But sadly, I'm not. Can I show you something that we've spun out of my fund at the end in the last? You don't have to stay for it, and it's something which we think as a separate standalone company we can get venture capital investment for. Okay. So if you could type in yes if you want. If you say no, you can leave. Right. And this is essentially it. It is the data. But what we realized is data alone is not enough, because then you've just got given people a load of information. Where's the wisdom? They need access to the individual. So we said, well, if we're going to create $1 billion company in a $1 trillion market, because this industry is a $1 trillion industry, then they need to be able to have access to the fund manager. That means necessarily we'll have to limit numbers initially because there isn't enough Alpesh to go around. So what we did is we said, well, let's give them all the data. And by the way, that's not the only data. It needs to have a bit more. And we did it for other stocks. And by the way, for the Dow, there's very few which meet all my criteria. If they don't tick every single one of the first 5 boxes, I'm not interested. Okay. And in fact, out of the Dow, there isn't anything on there at the moment. Now, but wait a minute, Alpesh, you said you own Microsoft. Yeah, we don't trade our investments just because actually that is in there. It's the only one which is in there, which ticks. Oh, no, I'm blind. United Health Group as well. So what about the others? Well, I wouldn't own them. What if next month it drops out of that? Because each month we update this. What if it drops out of that because the valuation got a bit? That's fine. You don't keep trading your investments. You hold for 12 months. You give it time once you've bought into it. Okay, very simple process. Very simple. Is it worth doing? Well, do you want 0% or do you want 40? Well, do you want 0% or 20? Let's just tone it down. Okay, do you want 0 or do you want 20? That's the way to look at it. And like I've already said, minimum 15 stocks. You can go as high as 50, but honestly, 40. After that, you're just creating hard work. Now, how difficult is this to learn? Let me tell you how easy it is to learn. So that's my former secretary. Okay, she was 21 when she joined my firm, straight out of university with a degree in English. And after 2 years, as you can read on all her SEC filings every time she launches a new fund, she joined Newton, and now she's at Polar, managing billions. I can teach an English graduate how to be a fund manager. And of course, like any man, I'm going to take full credit for the hard work of a clever, intelligent woman. But you get my point. You don't need a PhD in finance or a degree in economics to learn this stuff. Right? So people said, can you do it for me? I said, well, the whole point is I don't want to manage your money. You should manage your money. You should monitor it because you care about it more than anybody else will. Okay. And you don't want to be paying somebody fees for the rest of your life, like with fund managers. Right. And these are the people who have basically said, well, what can we do? And I said, well, I used to say, read my books, but nobody bloody reads books anymore. What can I say? Watch my TikToks. I guess that's the thing I'd have to say on that. So we've got a whole load of yeses, so I'm going to continue with that. Anyway, I perfected a lot of this when I was writing the books and writing the newspaper columns in the Financial Times. used it to win various competitions. That's me at university. When I had hair, oh God, why didn't I save the droppings? And could have glued them back on today. The problem we found in this market, and we thought, well, how do we turn this around? And I'm just going to show you my campaign for 1 million, to teach 1 million people how to be better investors and add 1 million across their lifetimes to their pensions, more than they would have done. Okay, ooh, we're going to have to update that soon. And you can, this is where you get the free copy of the book that I mentioned earlier, and a portfolio review and everything else, all for free on there. Okay. What we then went on to discover, and there's a whole load of my articles on there as well. What we went on to discover is actually this went on beyond just investing. It's all very well saying these are the problems and this is how we solve it. But what we also discovered is actually there's a bigger problem. There's financial stress involved if you don't make enough money, which I know is stating the obvious, but then we found data on it thanks to Bruin Dolphin, a broker. I don't have any relationship with them, but we found that. Okay, and that led to sickness as well. So there were all these other reasons why we discovered people, that's me talking about the markets, that's me talking about markets on the BBC, and I do a lot of it and off the BBC. What we discovered is that in actual fact, there's a hell of a lot of other reasons that people should do this beyond just having more and more. I get really excited sometimes. That's me on Newsnight. Beyond just that, they want to improve their pensions. And that's what it essentially then came down to. Okay. We said, well, how can we turn this around? How can we improve this? So we said, well, they should have access to me. They should have access to all the data. They should be taught all of this so they can do it themselves and monitor it. But most importantly, have access to me and not have to pay fees, because it's their money with whichever broker they choose. That's the best model. And that's the model I talk about when I talk about these things in the media. We had all these great positive comments from my industry peers and Financial Times and Coutts and American Express, Merrill Lynch, and all the rest of it, saying, yeah, actually, you know your stuff. So it's what we launched. We thought, you know what, instead of saying to people, we'll create we'll add to the problem and just create a fund for you and just add to the problem that you've already got, why not just give you all the data and let you do it yourself, but give you access to me. So at any given time, you can do it yourself. And then the feedback we got was phenomenal. We video recorded it. It was that good. You can see that on alpeshpatelreviews.com. And we created this so people can do it. So if you don't want to do it yourself, we'll provide you everything that you need. I'm going to answer some questions before I show you the link, because you're going to have to get ready for this. The reason for because it's first come, first serve. I only keep 10 available. FOMC decision, it does. What is the platform you use to review the charts? I like TrendSpider. Okay. How do you avoid the inevitable false signals given by lagging indicators? Experience, expertise. Will you have a replay? Yes. The Excel spreadsheet you've shown, the same data that's available with Alpesh. No, Theo, the answer is no. You wear a seatbelt because that is the law. I would wear it even if it wasn't the law, because it's a sensible thing to do. Which are the best brokers to get exposure to US markets? Anybody who's FCA regulated should be pretty good, actually, on that. Can I get a copy of the Excel file? Well, Niraj, yeah, move into my house and you can have it every night. And my pension manager should be sacked. I know. So we then looked at, well, how can we make this worthwhile for people? They should have updates for the rest of their lives, not have to pay subscriptions and fees. And how do you get venture capital investment into this? That's more my problem. Added value to a portfolio. Make sure they just keep adding value to their portfolio. Access to all the research and the data and everything else. Though most people don't care for that. Once they've got the call with me, and I had 2 with clients today, and the data, they just want to make the investments and then just monitor it now and again. No charges, daily updates, market updates, investment updates, and all the rest of it. And then we said, well, how should we look at this? What if somebody had a 100K portfolio? What if we could in just 1 year add 15% to that? That would be 15K, wouldn't it? Okay, but what if we did that over 2 years or 3 years or 4 years, whatever? Well, that's going to be significantly more then. And then we asked people, what do you want? And they said, well, we want the database. We want all the data updated every month. We then do more than that. We give a further filtered list, which filters that data that I showed you according to other criteria going even beyond it. And we also give, because we thought, you know what, I've got this, so I should give this. I also went on to create a whole load of educational material, which as I said, most people don't care for. And we wanted to tick every box. That's me. I call it the Great Investments Program. Wanted to tick every box that other people don't have. And that's what we managed to do. Okay. And like I said, we gave all this educational stuff like what's the cash return on capital invested, all these slides, everything else. But actually, most people don't want to go through that. They don't want to actually they just want to speak to me, get the data, and that's it. But the education's there, all the academic stuff from the Nobel Prize winners, Goldman Sachs reports, obviously economic outlooks. You can see the whole load there for 2023. We'll put the 2024 ones up very, very soon. But most people, like I said, don't want to read that. They want the database and they want access to me. We looked at numbers and we said, well, if you had a 500K portfolio and you got a 20% return, that's 100K extra you've made. That's 100K extra you've made on a $500,000 SIP. Let's say you only did that in 2 years or 3 years, extra beyond what you could have done. It's still 100K over 2-3 years, additional in your portfolio on that approach, additional in your portfolio on that approach. If you want to join the program, you're more than welcome. I've named a whole load of stocks for you. So 90% of the people, the reason I can do 99% of the things I do for free is the 1% who say, well, I actually want it. By the way, it's a one-off cost. It's one-off. It's not a subscription. It is not a subscription. It is one-off, just to be clear. And the value that people get is the updates on all of this. Now, I think this has got the potential to be $1 billion spin out because it's a multi-trillion-dollar industry, especially when we've got venture capital investment which are interested. And I may or may not take their money to make it global. We've got everybody from Australia and New Zealand all the way up to Canada and Mexico, as well as obviously UK people, because it's global markets for their pensions. And the pension crisis, where people are getting 0% over 2 years, when this year the market's up 50%, has grown worse and worse every year as the incompetence of the fund managers is unchallenged. Okay, additional questions, let me know. It is very much first come, first serve, I'm afraid. And the overall plan in the future is to get venture capital investment. For the first 200 people, it'll always be me mentoring. This is different to the trading. I'm going to do something separate for trading. That's completely separate. This is not trading. This is investing, remember. This is investing, okay? On the webinar, and only on the webinar, there's a 40% discount because I know I do a webinar when I can take on 10 people, and it's 10 max. On the webinar, outside of the webinar, the price goes up because my time's more valuable and you're coming on board outside of my normal availability. Okay, it's as simple as that, and you're in it for life. Thank you very much, Ravi. I am going to broadcast that comment. Thank you very much. Sneha, I'm not on LinkedIn because I'm quite a private person. Is there any other way to access? Yeah, just have a look at alpeshpatel.com/links. Alpeshpatel.com/links. All of it's social media. So, but I think you can anonymously see my stuff. Feds, no change. Thank you. Yes, I'd like to make so. Right. Any other questions? Let me know. Deepak, I can't quite see yours, so if you don't mind posting it again, then let me know. Other questions, let me know in case there's anything I have not answered. I try and keep these under an hour, and I've managed to do that just under an hour. So I'm really, really pleased on that as well. These are the critical points we were trying, like with any problem, we were trying to solve. And I love this. And I'll tell you why I love this. Unlike the asset management business, where I've got to go fly around the world and try and raise capital, which is a pain in the ass, through pension funds and through family offices. With this, all that stuff over my shoulder, those 18 odd books, translated into Mandarin, Polish, Russian, French, German, that's what this is. It's built up. It's joining the dots of my life and, you know, looking at the research from all the various banks and everything else and just putting it into today's format, which is very, very much, today's format is very much videos and content like that. And thanks to the internet, you couldn't have done this 10 years ago. You just couldn't have done it because you couldn't have had that much stuff. Thank you, those on as well. And I can see some old names on here as well. So I do want to thank, I better say thanks to Glenn, John, Steve, there's two Steves, David, Alfredo. Thank you all because I recognize you guys. And to those signing up, Carl, Suzanne, Howard, Barry, thank you all as well. Any questions at all, please let me know, because I'm keeping an eye on, unless I've missed any of them. How to manage your own pension? Yep, that's what I've done. What would you do with Amazon? Oh, very good question. The Apple strategy, which is I'd buy more right now because of the reasons I mentioned. It hits all the markers and the momentum is fine. And I'd adopt the NVIDIA strategy, which is if it drops X% from the highest it's been since I bought it, I'd sell Y%. That's it. Okay. Is it recommended to own a small collection of 5 quality stocks if you track it every few days? Well, I think the approach I've said is better. So not just too few stocks as well. Yes, it will be replayable. It'll be the exact same link you use to sign up. So alpeshpatel.com/latest shares. If you remind the strategy, alpha tax is correct. Yeah, absolutely. Niraj, I am more than happy to. Let me just go back over that. General market outlook for 2024. Brian, I used to say, if I was on the BBC, I'd say, I think I'm very positive about the market, blah, blah, blah. I don't even bother now. What I say is I buy a bunch of stocks, which if there's a tailwind, I'll do rather well. If there is a headwind, I'll have ample time to do what I did in 2022 and preserve the cash that I made this year. Okay, that's it. Beyond that, why waste your time with my pontification about the markets, right? Okay, I'm a bit positive because of earnings being so strong, but I don't want to confuse my results through all of that. So I'm not actually that bothered what the market does in 2024. I'm not gambling on it. So I'm not going to even think about what it does. I'm ready for it, whatever I get. It's a bit like the old, was it Muhammad Ali or Bruce Lee who said, everybody's got a strategy until, Mike Tyson, everyone's got a strategy. Everyone's got a plan until they get punched in the face. I've just got the plan. Whatever the market throws at me, I'm ready for it. Niraj, I think you asked, was it for this part? You're welcome to reverse engineer. There you go. Valuation, price earnings growth. That's it. And the factors that I look at, I'm ticking value, growth, income. Let me know if you think I've missed something, by the way. Don't forget, I'm looking at valuation, growth, income. So I'm looking at balance sheet, cash flow, and P&L. I'm looking at momentum. I'm looking at Sortino and Alpha, right? Outperforms of the market. Good returns for low volatility. And I've looked at the chart on it. I'm going to show you something secret now. I don't normally show people this. Let me see if I can show you this and pull it up. This normally I only show to my clients. So I'm going to show you something very, very secret. So we take that approved filtered list, and then each month they also get what's called the further filtered stocks every month. So this is December. Okay. And I show them this, and we filter it even more. Okay. For instance, we'll look to see if there's any stocks with a value which are undervalued by more than 50%, like ArcBest, for instance. All right. So that's what we do. Now, I'm not going to go through all of these because that'd be giving away the holy schmoly. But yeah, we do that as well. David, if you need more time, please email me. I will try. I've got a pension at St. James's. Now I'm worried. Wife's parents recently passed away, so sorry to hear that. So I have my 100K and 100K to this help. 50 years, she's 50. Chris, email me. I can't give you obviously individual pension advice, but I'm happy to direct you in sort of broad educational resources so that you're in a sound place. Okay, so feel free, Chris, to message me. Sneha, I would join once I manage to sell my practice. I can divert time needed. Actually, there's not much time needed. You need 1 hour. Because we do a 1 hour onboarding call, which educates you on everything. Then after that, you need 6 minutes every fortnight to monitor. That's it. One of the biggest mistakes I've seen people make, and they do this time and time again, they go, especially if they're business owners. So we have a bunch of people who are cash-rich, time-poor professionals, accountants, dentists, lawyers. Ravi, you're an accountant. And then we've got retirees and pensioners. They say, oh, when I've got time, I'll do it. Now, entrepreneurs are the absolute worst people at this. They work their asses off in their business, and then they miss investing and getting a 40%, 50% return on their capital because they're so busy running around, keeping busy. I think they've got psychological problems, to be honest. They're just running away from something. So by creating the flowchart, we simplified things to a level where even the entrepreneur doesn't F up their lives, which entrepreneurs are prone to do, by the way. They're not all Elon Musk. Well, he's messing up his life in many ways. So what we did is by creating those flowcharts, what it ensured is that all they had to do was once a fortnight for 6 minutes, look at my Telegram, then they'd know where they are, look at their portfolio, which they'd keep a note, nothing's fallen 25% from the peak. That's it. They didn't have to do the education. They spent 1 hour with me on the onboarding call and then 6 minutes every fortnight. That was it. That's it. That's it. Okay. I think I've answered everything. If that's the case, I'm going to go because, David, I've held one for you, so not a problem. Thank you very much, Brian. Thank you. I really appreciate it. I do appreciate feedback. So, by the way, if there's, I can do videos after this call, so I'm going to close the webinar, but please ask me any questions and I will reply to those and put those on my social media hereafter. Okay, so don't worry, and I will email you where it's not a video response. That would be appropriate. I'll email you where it's something personal, for instance. Oh, Chris, I'm sorry, I moved it to 6 o'clock, and I appreciate you might have been in traffic. The replay will be on alpeshpatel.com/latest shares, which is the same URL as you signed up for this. So there will be a replay and it will be on that later on today. So thank you all very much. I'm sorry if you can't sign up. It means they've all gone. I'm afraid the 40% webinar discount is for the webinar only, except David, who needed a bit more time. So I've kept one behind for you, David. By the way, yes, you're absolutely right. The price on this is, and I'm not just saying this, I'm afraid the price on this is going to go up because we index it. You know, with the cost of living, they say, oh yeah, your pension's indexed to inflation. Well, we index this to inflation, except our index inflation measure is the NASDAQ and the S&P 500. I've got clients making $1 million a year. You know, this is ridiculous that we don't index the price higher, I said to the team. So it's going to go up somewhere between 20 to 40%. 20 to 50%, because the NASDAQ's up 50% and the S&P's up 20%. It's indexed. The cost is going to be indexed. Now, I say, well, that's awful, Alpesh. That's terrible. Well, actually, no, it pays for all the data and the staff and the team. I'm a teetotal vegetarian who rides on a bike. I don't, my wife's got the car. I'm not using the money to spend it. It goes on the staff. And so, yeah, we're going to index it. Okay. Hi, Alpesh, where's the link to your book? Let me show you that again. Well, actually, if you go to campaignforamillion.com, you'll find it. Okay. Just go there. Can you see where it says in that box, campaignforamillion.com? Okay. There's the link to the book. It says free copy of the book. There it is. Okay. So you go there, campaignforamillion.com. You should be able to see that. Let me know in case you can't. That should be pretty easy to see. There you go. Oops, sorry. Anyway, you can see it. Okay, I think you can see it. Campaignforamillion.com. There, campaignforamillion.com, and you can see the book there. Or you can go to alpeshpatel.com/links. Okay, thank you all. Any other questions? You can still write them on this. Devak, just graduated from uni last year, but will invest once I have enough. Absolutely. You know, the best thing you can do when you've just graduated from university is just take, life's busy, just learn a little bit here and there. Watching this webinar is a good start because you've got so much time on your hands, in the sense that you've got a long life ahead of you, God willing, that as you learn a little bit, in 5 years, 6 years, it will really pile up as a lot of knowledge. So take your time and learn. And that's a good thing. And this webinar is probably a good place to start. So congratulations as well. I think I've done everybody as well on there. Any other questions? Let me know. Thank you all very much. And everybody who signed up, you will get an email from me. And you will also, this is where you'll have signed up. Okay, so you will also get, and you can do it in installments or in one go, but you will also, as well as the email, and there's only VAT payable. If you've got a company, let us know, we'll give you a VAT invoice. VAT is only payable if you're in the United Kingdom. If you're outside the UK, there's no VAT payable. You'll get an email and we'll set up the first call. The first call will take an hour because I'll explain everything that I've done today, but more slowly and one-to-one with you. We'll go through your portfolio and everything else. So you're all set up. Then after that, we'll just make sure you understand the flow chart for the process. You can call me anytime anyway. And that's it. Thank you, Devak, Paul, everyone else. Great. Right, guys. I am going to make a move. Thank you all very much. Like I said, any other questions, feel free to continue posting them. I will answer them either over email or video, because your questions are always the very best. Because basically, if you've asked it, I've not thought of it. And it makes great content on social media, where on TikTok, I have about 220,000 followers. It's crazy. One video is 3.6 million views. It's phenomenal. Thank you all very much. Let me turn, what did I turn off? I turned that bit off. Thanks, everyone. And like I said, any questions, let me know. Very excited for 2024. I've got to decide whether or not we take venture capital investment in. It's pros and cons, or whether I just grow it organically and fund it myself, which I'm very tempted to do, because then I get 100% control, which I really like. Okay, thank you all.